The following program is sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So it's Friday afternoon, and we're going to be talking about money. Janet Yellen and the Fed had their meeting this week, and they talked about interest rates. There was a great relief in the markets when they said they were going to take it slowly, very slowly. Market rallied in big time. You know, whether they take it slower, whether they take it faster, I don't think it's going to make a huge amount of difference. The Fed has a lot of control over short-term rates. They can raise the Fed funds rate. They can raise the discount rate. But what happens with long-term bonds is controlled by the market. It's not the Fed that controls long-term rates. And right now, with the dollar being as strong as it is, if you were a European nation, you could buy U.S. Treasuries last August and have made 20 or 25% improvement on your capital. Not interest, but because the dollar has risen that much against the euro, you could have made a lot of money. And so it makes sense that countries are buying the U.S. dollar when the dollar, or buying U.S. Treasuries when the dollar's moving up against their own currency. That only makes sense. And it's not the Fed that can control that. They can't control the rate on the long-term bonds. So whether they move quickly or whether they move slowly, it's not going to make a lot of difference. But market players thought that that was really positive. And then comes the question, with the market moving up like that, are we full of a lot of froth? Is the market about to come crashing down again? You know, we went through 2008, 2009. Are we going to experience that again? I want to talk about that. I think it's worth revisiting because you have, as I mentioned in a previous program, you have a dichotomy in the market. You have two different populations. Over half of the money managers that are managing mutual funds are under 30 years of age. Over half of managers of mutual funds are under 30 years of age. That meant they did not live through 2008, 2009. They were in college or high school when we went through the Great Recession. And it's one thing to know about a Great Recession and to see your parents go through it, to see the tough times going on, and to read about it, but it's another thing to live through it and watch your neighbors lose their jobs, lose their houses, watch an unemployment of 10%. It makes a huge difference. And so you have the young people that are managing money, and you have the older ones that have been around, that have gone through the dot-com, that have gone through the 2008, 2009, and they're expecting the market to come down, down, down. So you have this dichotomy, something that Adam Smith described back in the 1960s when he wrote the book and The Money Game. He described it as a kid's market because it is the young people that are driving the market. I believe that there's a lot of reasons that we should not expect another 2008, 2009, and I want to cover that today. I think that we're in a secular bull market. I've been saying that now for 5 years. I've been saying it may be the best bull market of our lifetime. Actually, I said 5 years. It's closer to 7 or 8 years that I've been talking about this market being the potential of being the greatest bull market of our lifetime. I talked about two themes. I talked about the super cycle, and I'll revisit that later in the program. And I talked about Dow 100,000. I believe we're going to get there, and I'll talk about that later in the program. And I'll talk about why I think it may all come to an end. Not soon, but in a number of years. But I first want to go back and talk about why I don't think we're headed for a 2008, 2009. And I base that on a couple books. Misunderstanding Financial Crises, Why We Don't See Them Coming, a book by Gary Gordon, who was with the Federal Reserve, who is a professor at Yale. And he talks about why the lessons have probably never been learned. And it's really inherent in bank debt, and the regulations are not going to stop it from having another crisis. But the conditions that set up a crisis, what are those conditions? That was the book. And also, he wrote a book, Slapped by the Invisible Hand, The Panic of 2007. Those were two books that he wrote. Professor at Yale now, he was at Wharton as well. And the other book is Stress Test by Tim Geithner, description of what they went through. When they talk about the invisible hand is the economy. It's something that's operating out there. It's almost invisible. There's something going on, and economists have been trying to call it a scientist for a long time, going back to Fisher in the 1920s, calling it some sort of science. No one's really been able to describe it, build mathematical models that are predictive and really reliable. But that's not what the crisis was about. That's not what the panic was about. From 1934 until 2007 is what's called the quiet period, or the golden period. We did not have a crisis. Prior to that time, we had one crisis after another. It started in this country in 1796, but they had crises in England and in France before that. In our country, 1796, following the Revolutionary War. The first really Great Depression happened started in 1834. We had another one in 1848. We had one in 1874 that lasted for over 30 years. Every other year was a recessionary year. It lasted for a very long time. Finally really ended, when the Federal Reserve was formed in 1907 or 1913. And of course, then we had the Great Depression of 1929, which we all read about. Nobody reads about the previous crises, but they were all a function of the same thing. And there's been a lot of misunderstanding with what happened through the Great Recession of 2008, 2009, misunderstanding of why it happened. A lot of people have called it, or a few people have called it, like Sherlock Holmes. You see what happened, but you don't understand. That's what Sherlock Holmes would talk to Watson. You see it, but you don't understand. It's the negative feeling. It's having gone through that have people looking at all sorts of things. What happened in 2007, what happened in 2008, was something that was very different from the previous crisis of 1929, of 1874, of 1834. What happened in 2007 was almost an invisible crisis. Very, very different. People have heard about bank panics. And essentially, when people talk about systemic risk and a systemic failure, what we're really talking about is a bank panic and a crisis. You had things that were invisible. People didn't understand. People didn't understand the risks that are involved. The credit default swaps, the repos, the CDOs, things that most people had never even heard of prior to 2007, 2008. But all of those related to debt. Debt's a key thing to understand in this whole process. It wasn't politicians, it wasn't journalists, it wasn't regulators. Politicians are not experts in the economy. They're not experts in healthcare. They're not experts in foreign affairs. They're elected to make policy. They're elected to guide the country. In the case of politicians, journalists to report it, regulators to review it, but nobody's really an expert in the whole thing. Economists are probably as close to experts as we come. In the process, in prior to the 1930s, what would happen is if you went through a recession, people would begin to get worried about the banks and whether their money was safe. They didn't have an FDIC before 1934. So if your money was in a bank and that bank failed, you lost everything. So when there was a concern about a bank, people would rush to the bank and pull their money out. Most people have heard of a bank run. That's when people go to the bank, they want their deposits back, they want their cash back. That's a bank run. And if you have just one bank, other banks will take their cash, gather up their cash, and give it to the bank that has a run, and you pay off the depositors. But if you have a multiple number of banks that are being run, nobody has enough cash to cash out the depositors. The banks close down, and you have a financial crisis. That's what happened in 1834. That's what happened in 1848, in 1874, 1876, 1879. Those were the times when you had a bank panic, you had a run, and you had people desperate to get their money out of the bank and the banks closing down and not giving it. That's what we experienced in 2007, 2008. Why? Well, we're coming to a commercial break, and I want you to stay with me to hear how that applied, because it was almost an invisible time. So don't go away. Stay with me. We've got more to come. And we've got a very special guest today as well. I'll be right back after the commercial break. Don't go away.
About Money will resume in a moment with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I've been talking about what happened in 2007, 2008. I believe it's something we have to revisit again and again and again. And I believe that there's a big segment of money managers that sits in fear of this happening again. I don't believe it's going to happen again. I'm not one of the kids in the kids market that hasn't experienced the tough times. On the other hand, I believe that we're living in the best potentially in the greatest bull market of our lifetime. And I don't want to steer away from that. I think it's going to end. It will end someday. But I think we're a ways away from that. But I don't believe it's going to end with a 2007 and 2008. And if it does, there's warning signs along the way. I've been talking about bank panics. We had bank panic after bank panic up until 1934. And in 1934, FDIC, a very, very controversial thing, the Federal Deposit Insurance Corporation, was formed and passed in Congress very shortly after Roosevelt took office. And FDIC guaranteed individual deposits by the U.S. government. Actually, it was a obligation, not of the federal government. It wasn't full faith and credit obligation, but it was an implied guarantee, an implied backing of individual depositors. And banks were forced to pay in a penny or a half a cent or whatever it might be during the times into a fund, so that if a bank did die, the depositors were able to draw that money out of the FDIC fund, and they were paid off up to $100,000. But something began to happen in the 1970s, and it really was in the 1970s. We began to have a shadow banking system. No longer were we talking about individuals with $100,000. We're beginning to talk about hedge funds, endowments, pension funds, not in the hundred thousands, but in the millions and multi-millions and hundreds of millions of dollars that they had locked up in cash, not just in the stocks, not just in bonds, but they had big cash positions as well. A whole shadow banking system grew up. And to ensure that, to come with something that was similar to FDIC insurance, banks would go out and get collateralized debt obligations which traded very rapidly, called repos. And because you wanted insurance in case something went wrong with the repo or the credit default obligation or collateralized debt obligation, you created credit default swaps like insurance for these things. And that whole system grew up. It was a shadow banking system. Began with the savings and loan crisis probably, and multiplied, grew hugely. So that on September 13th, 2008, when Lehman Brothers filed for bankruptcy, there was a real panic, a real crisis, because suddenly the people that had the repos, that had the collateralized debt obligations, the credit default swaps, suddenly didn't know if they were ever going to get paid. It was like going back to the 1920s, going back to the 1870s, 1830s, when the banks went down and went out of business. Were you going to get your money at? As an individual, if you had less than $100,000, your money was backed by the FDIC. But if you were an endowment, or if you were a pension fund and you had $100 million or $200 million or $400 million, were you going to be able to get your money out? That was the question. That froze the banking system. That's why the Treasury came forward, why the Federal Reserve came forward, and they began to pump money into the system because there were trillions of dollars that would be lost. But in order to get to that point, you had overlying all those credit default swaps, you had a tremendous amount of debt. The U.S. government was in debt, municipalities were in debt, individuals were heavily in debt. People were taking out all those equity loans, 125% of home values. You had the ninja loans, the no income, no job, no asset type loans. You know, you read the stories about the taxi driver in Bellevue who bought a condo where the monthly payment was more than his annual income. His monthly payment was more than his annual income. Those were crazy times, but that was the debt that was built up in the system. And when you have that kind of debt, when one domino begins to fall, one after another, you have a crisis. So if you look at where we are today, we don't have that debt. Households have deleveraged. In fact, they're more deleveraged now than they have been on the average in the 30 years prior to the buildup of all that debt in the mid-2000s. We're under debt, less debt than we had before. The municipalities have overlying debt, but they have revenues going up. And while everybody talks about the U.S. government and the amount of debt that's built up, governments build debt, and governments are different from individuals. Individuals, I have a finite lifetime. I know that at some point in my time, I'm going to pass away from this earth. And so are you. So is each one of us. The debts we cover are finite. But a government continues to go on and on and on. At least you hope it does. And so the governments, you look at the GDP of a government, the tax revenues coming in and compare that to the amount of debt. Now, as a homeowner, most people carry a mortgage. A large majority do. And you look at how you qualify for the mortgage. It looks at your income versus what you pay on the mortgage. That's true of the government as well. You look at the debt versus the revenues that are coming into the government, and a certain portion of those revenues are paying interest and debt, and they're able to refinance the debt over and over again. So that's an ongoing situation. But if you look at the GDP compared to the actual debt today, we're in fairly good shape. We're not where we were at all in 2007, 2008 on any level. And while corporations are issuing a lot of debt, that's also something that is a standard kind of thing. When interest rates are really low, corporations issue debt and buy back stock so that when interest rates are high, they can sell stock and pay off the debt. It's a classic model. So corporations issuing debt is not really a function of fear or worry. And buying back stock is not something that is crucial. It's happening. It's happened before. It's going to continue to happen. When interest rates are low, companies issue debt, buy back their stock. That's the way it works. Anyway, that's the reason I don't believe that we're going to have a 2008, 2009 type of end to this secular bull market. But it will come to an end at some point in the future. And after my guest, I'm going to tell you why I believe that's going to happen. But first, I want to tell you, yesterday there was a trade show. I don't know if I call it a trade show or what it was, but surf is I don't know if I would call it an accelerator. I'm not sure exactly what to call it, but it's a number of small startup companies that provided space in one of the high rises in Seattle, and it's a place for them to get together. These are startup companies. Most are pretty high-tech companies. They're looking at certain markets. Each one has its own market, and it's something that Seton Grass, who was on the program maybe 5 or 6 or 7 years ago, it's been a while, he was the founder of Surf. We were in on the beginning of that. Now seeing how that's evolved and what's going on, it was really interesting to do. One of the people who was at that is the CEO of a company called Brevity. So I want to introduce him, the CEO and founder, Bob Clow. Welcome to the program, Bob.
Thank you very much. Happy to be here.
So why don't we start with your background?
Okay. Many years ago, too many years ago perhaps, I was pursuing a PhD in political science and off to Moscow to write a dissertation on the development of the Soviet computer industry. And as soon as I arrived, the wall came down. Things were happening. Gorbachev was talking about perestroika and glasnost, and businesses were popping up all over the place. And I decided to put the dissertation on hold and get involved in some businesses. And lo and behold, 2 years later, Microsoft came along to open up a subsidiary in, at the time, the Soviet Union, and asked me to take on that challenge. So I joined Microsoft. I developed the subsidiary there for another, 4 years or so. Then I moved to Munich, Germany, and ran East European sales and marketing for Microsoft. Then came back to the States and ran small business sales and marketing for Microsoft. And ended up a few years ago looking for new challenges, and so I punched my Microsoft lottery ticket, and started a couple startups, got very involved in the nonprofit world in the Seattle area, and started my next chapter. And in the last couple of months, started Brevity and our new product that we called Go-To-List. And just yesterday at the Surf Incubators Expo, we had our reveal. For the first time, we revealed it to the public to gauge what the reaction is. And so we've formally launched our new product.
So we're going to talk about that new product. It's really fascinating. And the previous companies that you ran were also very fascinating. We've got just less than a minute to describe. So tell us quickly about your previous company.
Yeah, one of the The previous company that I used to that I helped found is called TorqueWorks, and it's still around. It's still doing good work, and it's another software product that is sold to state unemployment agencies. So we're in 10 different states where an unemployed individual walks in, and they use our software to look at their career background, and from that pull out what are the skills, knowledge, and abilities that are part of that background.
We're going to come back right after the commercial break. Don't go away. We'll hear about that and the new company as well.
More about money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I'm here with Bob Clow, and before we get to brevity, I just want to finish this one thing on his previous company. The result of this was...
Yeah, so for example, in the state of Alabama, we were able to show that those unemployed people that used this particular tool spent half the time on unemployment benefits and so forth than people that weren't using the tool. So we were able to connect people's existing skill sets, identify similar jobs with a little bit of training they could transition to, and therefore their time on unemployment was reduced greatly.
Fascinating, great deal, and a positive thing for the economy for everybody involved.
Indeed, win-win-win.
So let's talk about brevity. Start first of all with the name brevity.
Where does brevity come from? Brevity is a focus for me in my life in many ways. Brevity is very hard to do. And I remember a quote from Churchill that goes something to the effect of, if you'd like me to speak for an hour, I'm ready to talk now. If you'd like me to speak for 3 minutes, I need about a month to prepare. In other words, doing things really well, very short, very concise and precise is hard. It takes time. Doing things in the software world, for example, to make things simple is really, really hard. And so to get across concepts, to get things efficient, we like the term brevity, because at the end of the day, that's what you would like to accomplish. You would like to accomplish things with brevity. Just get it done efficiently. And so that's the name of our company, because that's the concept that we use when we design our software. And as I said earlier, our first product is a product that we call GoToList, which we revealed yesterday.
So tell us about GoToList.
GoToList is designed to help out that wonderful human being who needs help today, but that wonderful human being that raises their hand and says, I will organize this group of people to get this stuff done. And it's mostly in what we call social groups with purpose. And so you can think of volunteer boards. You can think of kids' soccer teams. You can think of bridge clubs. You can think of neighborhood associations. All of those social groups that somehow get together because they're trying to accomplish something. Now, it's not making money. It's not a business, but they're trying to accomplish something, and that's why they form themselves as a group. And unlike their brethren or even themselves in the workaday world, when they go to a large company and they have a mission to accomplish, we're trying to serve our customers or build a product, the enterprise world has an amazing set of technology tools to make those people more efficient, to help them share their calendars, to communicate via email or phone or chat, to be able to understand the impact of what they're doing, to be able to get opinions very quickly. Those tools exist for that space. Those tools do not exist for the rest of us in our regular normal lives. And so we are very focused on trying to come up with a mobile application, because that's where the world has gone, right? Things happen on mobile platforms now, and so you have to provide tools for them there, because that's how they tend to work now or even live. And so we're a mobile application that makes it easy for these typically volunteers that will pull these groups together. And so it gives that group very easy access to contact information or group calendar or taking polls like, can you make it to this time, or which restaurant do you want to go to, internal chat. And so all of those tools on one platform, on one product that they can use on their phones.
And so what's the advantage of using GoToList?
Yeah, there's two things. Number one, all that functionality that I just talked about is in one place, right? So there's lots of services out there on the web that will take a survey for you or will manage your group calendar, but they're all in different places. And so you'd have to put your information out in many different areas to actually manage your group. We're pulling all that together. And number two is we've picked up, certainly in the last several months, a growing concern among that population and in general the population around privacy and the use or the misuse of people's personal information by providers of services that are out there saying, wait a minute, you're using my information for what? And so we see it in the backlash, frankly, in Facebook, concerns about Google and their monetization schemes, about how they don't charge you for things, but they monitor your information. They will then advertise to you, or they will take your information and sell it to other people. And maybe it's anonymous, but if, as they say, if you're not paying for the product, you are the product, right? And so
that's true.
And that's very much out there. And then I'm getting a lot of feedback from people that think it's kind of creepy to be out on the internet browsing through something, and then all of a sudden an ad pops up for a vacation to the Bahamas. And you think, no, wait a minute, my email service is free. And 3 days ago, I sent an email to a friend saying, I'm thinking about going to the Bahamas. And 3 days later, I'm seeing an ad? What's going on there? That's a bit creepy, right? And so concerns about the misuse of private information like that, I think, is driving people more towards, I don't want free services. I don't want my information to be used in ways that I don't know. And I'm not saying all those people are evil or all the providers of those types of services are bad or wrong. They're doing what they say they will do, right? I'm just not sure that their customers really recognize the contract that they signed. And so we think there's going to be more and more resentment about that, more and more concern. So we've built both a technology solution, but more importantly, a business setup, a business organization that says, we're going to create a very nice service for you. We're going to make a decent living doing that. And we're going to charge you a fee for accomplishing that service. We're not going to use your information for anything. Your information is your private information. We're not going to market to you. We're not going to sell you ads. We're not going to take your information and sell it to somebody else. That information is yours. We're providing this wonderful service on the web and in your phones, and you're going to pay us an annual subscription fee for that service. Hallelujah, win-win.
It's a win-win. But there's another aspect to what you're doing, and that's for the person that has the spreadsheet that they kept, or the addresses and the phone numbers and whatever.
Right.
There's an aspect to your technology that improves all of that as well.
Right. And, it's kind of a personal challenge because, I'm a father. I remember my kids are in college now, but I certainly remember the days where in our car, we had a printout, either the publication of the directory, we had a printout for the neighborhood association, we had a printout for the school class, we had a printout for the church, we had a printout for the kids' volleyball team, we had a printout of the kids' soccer team. We had all of these pieces of paper with information all over the place because you never knew. I never forget picking up my kid from soccer, and his buddy Johnny was sitting next to him. And Johnny was the last kid to be picked up, right? And it's like, Johnny, where's your mom? I don't know yet. Well, you're not going to leave Johnny there, right? Yeah. But you also don't have Johnny's mom's phone number. Well, hell, I'm a dad. I don't remember Johnny's mom's name, right? And so it's like, how do I get a hold of Johnny's mom? And so luckily, Johnny knew the phone number, right? And so we were able to call her. I'm sorry, I'm late. Can you stick around? Absolutely. I'd be happy. I'd take him home if you want, right? And so it's those kinds of challenges, real world challenges, that if I were an enterprise and sitting, if I was an employee of a large company, I could very quickly look up in the employee directory and find out how to get a hold of somebody. I can't do that for the groups of people that I interact with on very important social issues, right? And so we're trying to provide tools that in a private way and not abusing this information makes it really easy for parents to take care of other parents' kids, for nonprofit boards to manage themselves, to share calendars, to take polls, take advantage of all this wonderful technology that many large organizations have professional IT staffs to do. And we're trying to take all of that stuff, simplify it with brevity, and simplify it and make it very both accessible and easy where they want it on their phone and at an affordable price.
And there's another aspect to it as well. And that's the data entry side.
Yeah. Yeah, and when we were talking to these wonderful volunteers that raise their hands and say, I'll take that burden on, I'll be the secretary for the board, we asked them what were their biggest hassles, what were their problems, right? And we had a certain set of expectations, but the main thing that kept coming up is, I don't want to be a data input person. Right? I'm tired of people sending me information that, hey, my cell phone number just changed. Can you put that in the directory? Or my email changed. My address changed. We just got divorced. Can you do this? Like, why am I a data input person? Right? And so we listened to that. And so rather than spend a ton of money developing the latest and the greatest technology to import information that already exists from that group, we kind of turned it around and said, number one, we're going to relieve that organizer of the burden of doing the data entry. And we're going to allow the member of the organization to provide their own information. So that makes it much easier on the organizer. And secondly, for the member of that group, now they have full control over what information they want to share with that particular group. With one group, you may want to share your home address. With another, you may want to share their business address. With another, you may want to share your cell phone and your husband's cell phone, for example. And with another, so the clarity on being able to decide what I share with whom, and then being confident that it's staying only there, is a really important, quote, feature or aspect of the product that we heard directly from our customers that's what they wanted.
Well, it sounds incredible. And
Thank
you
you.
just launched yesterday.
Yeah, we just went public yesterday with, we're in beta, and so we're still learning. We took an idea that we heard 2 days ago from one of our beta customers, and we implemented it. It'll be out in market next week. So we're in that wonderful stage of startup that things are happening very quickly, and we encourage people to try it.
So if people wanted to log on and actually try it, how would they do that?
Yeah, the best thing to do is go to our website, and it's www.goto-list.com, or you can do an internet search for GoToList. It's your go-to list, right? .com, and just create a free account there, and then you can start creating your own groups, or you can go to any of the 3 mobile app stores. So we're in Apple, we're in Windows, we're in Android. You can download the app for free there, create an account, and start away.
Sounds very good.
Thank you
Thanks
very
for
much.
being on the program.
My
think
pleasure.
It's a really interesting concept.
Thank you, and thanks to Surf Incubator. They offered a really good program for us to be able to make this launch.
That's great. Don't go away, because we'll be right back after this and talk about this secular bull market and how it might come to an end. Don't go away.
Stay tuned. About Money returns in a moment with your host, Mike Adams, here on Business Radio 1300 KKOL.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So, in the first part of the program, I talked about why I don't believe that we're going to go through another great recession as an end to this secular bull market. And I believe that we're in a bull market which is going to probably be the greatest bull market of our life. It's going to be better than the 1982 to 2000 bull market, one that lasted for 18 years. Yeah, we had some corrections. We had the worst down day in market history on October 19th, 1987, but the market recovered and it continued to go on. I think that what you just heard about brevity and the many companies that are coming along, change is happening so fast and so incredibly fast. When you think back, and I've mentioned this before, when you think back to 1966 and the blue chip stocks that made up the Dow, there were companies like Anaconda Copper, American Can, American Tobacco, Bethlehem Steel, Johns Manville, Swift and Company, Woolworth, Union Carbide, Westinghouse Electric, and Woolworth. I mean, those companies, some of them don't exist today. And when you think about the companies that are in the Dow today, companies that didn't exist, McDonald's came public in 1966. But you have Starbucks, and you have Amgen, and you have Microsoft, and Intel, and Qualcomm, and Genentech, and Amgen, and you have Cisco, and these companies that all were unborn in 1966. Change happens fast, and it's going to continue to happen fast, and we're driven in a technology type market. We're seeing that happen, and I believe that's going to continue to happen. I've talked about the super cycle, the long-term cycles where world GDP grows faster than the average. And those super cycles last for a number of years. The first one from the 1870s to the 1913. The second from 1945 to 1970. And right now, that super cycle that began in 2009 could last for another 20 years. It's a time in which I believe the Dow will go to 100,000, maybe even as high as 200,000. But I believe that there will come a time when it will come to an end. If you look at where we were, as we've grown up, our parents, our grandparents, they lived through the Great Depression. They lived through a time in which people were losing jobs, where there was high unemployment. The economy was really devastated, not just in the U.S., but worldwide. And when you look at that period of time, as people lived through that, as they came through as children, as young adults, as they grew into positions of power, they wanted to prevent that from ever happening again. They knew what they'd gone through, and they didn't want their children and their grandchildren to go through the same thing. So as we came to the 1970s, and they saw a brittle recession taking place, and they saw what was happening through that 1970s, they saw a way to inflate their way out of it. They were willing to inflate their way out to prevent another Great Depression. And if you lived through that time, we saw interest rates on treasuries reach as high as 17%. You know, today it's hard to imagine when we've got treasuries that are at 1% and less than 1%, to imagine treasuries at 17%. We talk about financial planning and some of the things that have gone on in financial planning. And if you've listened to the program, you know I don't believe very much in financial planning. I believe the assumptions are all wrong. But some of those assumptions came out of that time when interest rates were high and when it made sense to do a combination of stocks and bonds, a 60-40, whatever it was, and set that up because interest rates were high enough that they made sense to do. When you have a 1% interest rate on a bond, it doesn't make sense to do a 60-40. You know, that's just almost nonsensical. But at that time, with interest rates where they were, it made sense. It was a dynamic world, and those times changed. But at that time, those people that had lived through the Great Depression or experienced that, they were willing to inflate their way out of the risk of another Great Depression. Now you roll forward, and the people that lived through that time of hyperinflation, of high inflation, they began to gain power. And the people that had gone through the Great Depression were retiring and were leaving office, were doing all those things. Now you get to 2007, 2008. Remember in 2006, 2005, the 2000s, countries were talking about limiting the amount of inflation. Even today you hear that, limiting the amount of inflation. Inflation was not going to be higher than 2%. 2% ceiling, not going to have more than 2%. We have a depression, we don't care. We're not going to have inflation higher than 2%. We're willing to take a depression. We just want to make sure we don't go through inflation. Think about it. Some of that still pervades today when they talk about not having high inflation. But think about what Janet Yellen said. If you listen to Janet Yellen testify after the Fed meeting, what did she say? We need more inflation. We're waiting to see more inflation. We're waiting before we begin to raise interest rates. We want to see a pickup of inflation. I don't know if you picked up on that, but I sure did, because I've been talking about it for a little while, for a few months, talking about that's where we will probably end this bull market. We'll come to a time in which the people who lived through it, the young people who lived through the Great Recession, who experienced it, who lived through that time of seeing their neighbors unemployed, of seeing their neighbors who had set aside educational money for their children, not having enough to send their children to the schools they wanted to go to because the money they set aside had fallen in value so much. When you saw people who had planned a retirement at 65 or 67 or 70 years old, suddenly seeing their nest egg crumble down. They've seen all those things happen. What will they do? They don't want to go through that again. So when it comes that time, what will they do? They have also seen what we did during the Great Recession. What did the Treasury do? What did the Fed do? They printed money. That's what got us through this time. So when we come to that time, in 5 or 10 or 15 years, and who knows how long it'll be, what I would expect is, as a preventive measure, the idea will be to print money so we don't go through a Great Depression. But in doing so, we will start the inflationary cycle probably worse than we experienced in the 1970s. I think that's the highest probability of how that's all going to end. But until then, I believe we live in a kid's market, and I believe there's a chance to experience this greatest bull market of our lifetime. And I do believe it will be the greatest bull market of our lifetime. And it's not going to end this year or next year or in the next 4 or 5 years. We're going to see it continue for quite a while. Be there. What is it the Scots say? Be there or be square? That's my advice. That's it for the program today. Have a very great weekend, and I'll be back next week with more insights on industries and economy. Until then, have a very wonderful week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3. For more about money with Mike Adams, here on Money Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following